Hello everybody, April 21st, 2020. It's my second video now. I was trying to go for that lumberjack look, but it didn't work out, so I decided to get a bootleg haircut. I want to talk about the state of the economy and real estate market, my economic outlook. Purely my opinion. Everybody has one, so you can take mine and compartmentalize with all the other opinions you guys been getting. I've been listening to economists, been influenced a bit by Christopher Thornberg, by Barry Habib. I read Jimmy Dimon's report from Chase and Goldman Sachs. Some of the other ones, but I am very, very optimistic about coming out of this recession, coming out of this pandemic. There's multiple reasons in my mind that I think so. Let's talk about economy first. So it looks like we will be in a recession. Whether technically recession is 2 quarters of negative growth, certainly second quarter will be negative. Looks like third quarter will be positive. So if you go by textbook definition, we may not even hit the recession. But all in all, whatever you call it, it's pretty bad. Unemployment is bad. It's gonna hit what, 20% now? And the biggest question is unknown. When are we gonna come out of it, and how we're gonna come out of it? When is this pandemic is gonna be over, or stay-at-home order? When it's gonna be over, and how will it look? Will they limit amount of people in restaurants? Will the restaurants be open? But it looks like to me, when we do come out, whether it's late May or June, the first thing people are gonna go do, they're gonna go get haircuts, they're gonna go get their nails done, they're gonna go see their friends at the restaurants, at the bars. Maybe it's not gonna be the same as, same crowded bars as we remember, but people will go out, people will go spend their money, and people's memory is also short. Yes, a lot of people lost their jobs, but most of these jobs will come back. We may not see 3.5% recession, 3.5% unemployment rate, but 3.5% unemployment rate was not healthy to begin with. It was too low. It was very hard to find workers. So I think when we come out of it, things will not go back to normal right away, but eventually people will start spending money. Yes, travel may not be the same as we remember. Vegas may not be the same, but Christopher Thornberg said it in his last video. He said, so people will travel to Disneyland not in April, but in July or August. And I do agree with that assessment. So I think that the starting point for the economy was very, very strong. It's not, some people say it's 2008, but even if you look around at your friends and people on the street, you don't have that doom and gloom, depressed look on most people's faces. Yes, some people lost jobs, some people are not feeling good, but in 2008 it was really, really bad. A lot of people bought real estate with 0% down, they bought investment properties, and they lived off their equity. They didn't have enough income, but they thought they were rich. And when the last crisis hit, economic crisis, just the look on people's faces, the talks, it sounded and it looked pretty bad. Now people want to actually go out there, want to go back to work, want to go out in a park, want to go out at a restaurant. So this time This time is different, right? It's those three words that in investing that are very dangerous. This time will be different, but to me, it's really positive. I think people will go out there and will spend their money. Now let's talk about real estate. I know real estate in California, so little disclaimer, I cannot talk about other states, other places in the country. I know Texas economy and real estate may be more dependent on oil than on anything else. But let's talk about California and what I see happening. Real estate activity now is pretty slow. Investments pretty slow. Some people are sitting on cash. Some people are looking for bargains, and 80% of the people are just not coming out of the houses. We see some activity. We see people buying properties, buying investments, buying owner-occupied, but not much at this time. But the same token, we don't see a lot of inventory. People are not listing as many properties, and we don't see price cuts yet. So everybody's waiting for stay-at-home to be lifted, and we'll see where it's going to take us. Again, my outlook on the economy is pretty good, pretty optimistic. A lot will depend on the unemployment number at the end of the year. I don't think we'll be in double digits. I think we'll finish the year maybe mid-sixes. Some jobs will be lost, some jobs will be relocated, and but overall, I don't think we're going to see tremendously high unemployment rate. It peaked at around 10% last time around in 2008, 2009. So I think people will go out there and will carefully continue to where we left off. We see schools will start in September. People will need to start relocating, start buying houses. They would have been doing this already, but it's a little bit different market now. Another positive is there's a ton of money in 1031 exchanges. 1031 exchange kept the market up last time, maybe from 2006, 2008. There is, investors will be looking to roll their 1031 money into something rather than paying taxes. There's people with 8-9 figures in 1031 exchanges. How this is not like 2008 is just not. The banks are not. We're not doing 100% financing. Yes, the banks relaxed a little bit. They've been offering 5-10% down payment products in the past 2 years, but overall, at least between 2010 and 2016-17, most of the buyers would put 20, 30, 40% plus down payment on the properties, and there was a lot of cash buyers. There was a lot of foreign buyers. We did not see as many foreign buyers in this market, this time around. So we're not going to see that wave of foreclosures that we saw in 2008. People have equity, and also the starting point. If you look at minimum wage in California is $15. So figure husband and wife, $15 and $15. That's $60,000 a year. We're talking about absolute minimum. They Uber a little bit at night. That's $80,000-$90,000 a year for a hard-working minimum age family. These people can afford to buy homes. In 2008, wages were much lower. the minimum wage was lower, and wages for skilled labor were lower. So if you look at the prices today, or pre-corona at the peak, they're about the same, give or take, as prices at the peak in 2008. Also, interest rates are much lower than they were in 2008. 2008, we saw mid fives, low fives, maybe high fours at some point. But overall, I mean, we're seeing mid threes in interest rates for bankable product. It's just not that type of market. People are not overextended, and this corona thing, it's very temporary. It will take some people to get, some time to get back on their feet, but it's just not the same. Savings rate is a lot higher than it was in 2008. Partially maybe because baby boomers are getting older and that's a bigger part of the population, but it's not that type of market. So also, I just touched on interest rates. In my opinion, interest rates will be lower going forward. Yes, Fed is buying paper, mortgage-backed securities. At some point, they will start to unload them. Rates may go up, but it's not going to happen in the next 2 to 3 years, in my opinion. There's a little bit disconnect between interest rates that the banks are offering now and where mortgage-backed securities are. So I think interest rates will be even lower. Also, even before this pandemic, almost $20 trillion of world's wealth was invested in negative yielding bonds across the world. UK, Japan, Australia. A lot of countries have negative yielding securities, but our 10-year treasuries are still paying, now it's 0.5% or a little bit more, but it's still positive. We have a stronger economy, we have lower risk of buying US treasuries, but eventually it may, in my opinion, go negative as well. This will have an effect on interest rates. There is hunt for yields, but it's a different type of hunt. For some companies, 0% yield is not bad. So it will certainly impact mortgage interest rates. So how about oil? Oil went negative yesterday. It's a whole different markets than we're used to. But I think real estate will be a safe haven for a lot of the investors. It's very known, it's very tangible, and it's not going anywhere. Can it adjust 10% or maybe even 15, 20? Yes, absolutely. I don't see a 20% drop 6 months from now. We must see, but I certainly think the prices a year from now will be higher than they are today, for sure. Retail real estate will certainly suffer the most, in my opinion. It's going to take the longest to come back. But even pre-corona, we had writing on the wall. You see some companies talking about filing for bankruptcy. I think corona just expedited their fate. Some of the retail operators were profitable just because of their real estate holdings and long-term leases they signed pre-World War I. But it will be tough for the retail sector. Otherwise, single families, multifamilies, I think they'll recover nicely. Okay, guys, I think I'm gonna be wrapping it up a little bit, and there's a lot of unknowns, obviously, when this social distancing is gonna be over. Oil sector does not look good, and since we are net exporter country, it is this sector employs a lot of people, so we're gonna have to see how that plays out. It's certainly not a big sector in California, so we may not be hit as much as Dakotas and Texas, but it's part of the overall economy. How many jobs will come back? Will we be at 5% unemployment rate at the end of the year, or 8-9% unemployment rate at the end of the year? There's a lot of unknowns, but overall, like I said, I'm positive. You should be too. And until next time.